I'm here with Patrick Krueger. He's the first guest on my new YouTube channel. We're going to be talking about global macroeconomic events impacting markets and impacting the financial industry. Let's get into it. How are you doing, Patrick?
Good. Yourself?
Quite good. Really excited to have you and excited for this interview.
All
Let's
right.
get into it. My first question for you is, we saw Blackstone default on a $562 million commercial mortgage-backed security backed by Nordic Properties. They also have another loan in special servicing in New York, backed by 10 or 11 New York properties. And at the same time, we saw them buy AIG's CLO business, and now I'm hearing they're making a bid for some assets of Silicon Valley Bank. From your perspective, what do you think about this with some of these big institutions clearly suffering in terms of their investments, but then also continuing to make large capital expenditures?
Well, I think that's one thing about banks is they do invest in things. That's generally their business model, especially the types that aren't custodian banks. Because custodian banks, that's not their business model. And I do think it seems like a lot of big institutions still think that they can somehow salvage the Silicon Valley Bank situation. It seems like something that I've been looking at, reading into. It seems like something I can recognize. I think part of it is that they are probably also trying to prevent a cascading effect from the Silicon Valley thing, because a lot of our economy and a lot of our system is based around perception, sometimes more than reality. And if, they might try to be doing this to try to build confidence to prevent like a bank rush on Silicon Valley Bank that could be cascading out to other banks. That would be very disastrous for everyone.
And what about, some of these more investment banks, like we've seen Goldman Sachs has suffered quite a bit in their consumer business. They've laid off thousands of employees, but I'm hearing they're considering a leveraged buyout of Subway restaurants for $10 billion. They're currently bidding against Bain and Texas Pacific Group, and there might be more bidders that'll come in. What are your thoughts on that? Do you think this is more of a systemic thing, or do you think some of the damage is contained at a few of these idiosyncratic names like the Silicon Valleys and the Blackstones and the Goldmans of the world?
Well, yeah, I would definitely say that there's a lot going on. Now, we would like it to be something that's localized, and probably Silicon Valley Bank and especially these ones that do lots of venture capital, are going to be the first in the long line of dominoes to have some problems. But overall, I don't really see a good way you can shut down the economy and just run the money printer over time for 2 to 3 years and expect that to not have any long-term effects. And I think that there's a lot of stuff going on right now that is definitely related to that. I definitely think that with a lot of Silicon Valley, I think that this could or could not be related to what's going on to the bank, but I definitely think that there is a giant bubble when it comes to a lot of tech stuff. You can usually tell when there's a bubble when people are starting to get too greedy and they think that everyone's going to just sit there, get rich quick on Tesla stock, on whatever, venture capital, tech startups and stuff. And actually, I've gotten from some sources that Silicon Valley itself almost runs like a pyramid scheme, where most startups, their goal is not even really to create good products, and their goal is literally just to get bought out by some company like Google or Facebook. And many of the times, a lot of these sort of angel financiers, they even know this, and they don't necessarily care about building the best product. They just want to invest only a little bit of money and then kind of build a hype around some company and get it bought out by some company that's just so, there's so much money burning a hole in their pocket, like someplace like Google, Facebook, that, that, and a Silicon Valley Bank as one of these sort of venture capital interested kind of parties is probably been participating in this a little bit. And I think now the hens are coming to roost, and it's not working out very well, because if you're building a whole economy on hype, it's just destined to fail. And I think that that's a big problem with a lot of tech stuff, especially because a lot of the people in that sector are very visionary. They think that, well, I'm going to change the world, and they have this kind of, it's very much so about like this mindset that's not really about good fundamentals. And I think that because a lot of people are kind of in that mindset, a lot of them get themselves in trouble.
Absolutely. It's surprising what's going on there. Switching over to the ESG world, one of the big developments in the ESG world is that the Vanguard Group, the second largest asset manager in the world by total assets under management, they've taken a firm stance to the opposite of the rest of Wall Street. They backed out of their ESG mandate. The CEO, Tim Buckley, affirmed his fiduciary duty to clients. They're coming out with research that says ESG investing has no benefit over broad-based indexed investing. From your perspective, how do you think this will affect the industry? Are we going to see some of the smaller firms follow Vanguard's lead? Or do you think this is more of a one-off event where this is just one firm?
I hope they give up on ESG investing. ESG investing has been a disaster. I think that for the most part, once again, it's talking about these ideals and not focusing on the fundamentals. The ESG scores are pretty much one of the biggest reasons that you see all these companies promoting very strange things, and kind of having these very polarizing political stances on things, because they think they're going to get a better credit rating, and you've got lower interest rates for pushing an agenda. But nothing about pushing an agenda gives you better credit worthiness. It's just so obviously kind of a hoax, and it was something that was originally started to, once again, kind of start this fundamentals thing of this idealistic thing of, I want to go change the world, make it better or whatever, and I'm going to do it through capital and controlling capital. And fundamentally, though, if any business that has a fiduciary responsibility will eventually realize that actually, usually investing in the business that claims to care the most about carbon offsets and social justice movements doesn't necessarily mean that they actually have a good product, that they're making good decisions. And if anything, I would argue that it shows that they put a lot of effort into things that aren't that. I mean, think about how many employees get hired at these sort of companies, like these sort of marketing people that really aren't adding value, but they take a salary, and they post a lot of stuff on Twitter. And is it really generating any? I mean, I'm not seeing how, posting some stuff on Twitter about, Pride Month is making me want to buy another sandwich. It doesn't. It doesn't do anything like that to me. I don't care. So it's just showing that somebody and most people I know, including the progressive people that appeals to, they don't care. They're not sitting there thinking, I'm going to go figure out, calculate which business makes the most Twitter posts for whatever, social month it is. And then that's why I'm going for lunch every day of the week. Nobody's doing this. And when you really dig into it, it makes it seem like, well, there's full-time employees at these places that are taking a full-time salary. And some of them are high up executives, and their entire job is just to advertise in this way that doesn't generate any revenue, that I can see. If anything, it generates negative revenue, because you could isolate a substantial part of your customer base. And I think that the ESG score is an excellent example of a failed experiment. And I think that that's what these other institutions seem to be recognizing, which is the same thing I'd be recognizing if I were in their position.
Yeah, and they're recognizing that, but at the same time, in 2022, the five largest oil companies
Mhm,
in the West, British Petroleum, Royal Dutch Shell,
mhm.
Total Energy, Chevron, and ExxonMobil, made a combined $200 billion of net income. And ExxonMobil in particular set a Western Hemisphere record with 56 billion of the 200 in net
Wow.
income. So do you think this is really a short-term play by some of these institutions to get back into oil, or do you think they're really taking a stance on behalf of clients?
Well, I mean, I'm someone who's very big in that in into the industry. Like something I'm a firm believer in is people are always going to need gasoline, oil. I mean, everything. The plastic that my water bottle is made of, this needs oil. Everything needs oil. It's always going to be a good industry. I mean, long term. I mean, until we run out of the stuff, and even then, I'm not sure we ever will really. I'm sure by this point we're going to get some ways to go and use alternative biofuels or whatever. But at the end of the day, all of the petrochemical industry is always going to be long term. It's just better engineering than switching to batteries, like for electric cars. No matter how you can't ever fully get rid of oil because even the electric cars need plastic that they're made of. That plastic is not something that comes out of a tree. It's not something that comes out of solar panels. It's something that comes out of crude oil. It's a byproduct, and so that it's always going to be a good idea to do that. Also, I mean, petrodollar is still alive and well. So oil is always going to be important in that way. And maybe it is a play for them to get into oil because I'm guessing one of the things about ESG scores was it was specifically a way to try to de-incentivize oil and move to things like solar and wind and whatever else other stuff that is politically expedient. And I say politically expedient because even petrochemical, you can have very clean energy from natural gas. People don't want to know. People don't want to talk about that, but natural gas is extremely clean. But you're not getting an ESG score bonus near the same for natural gas as you are for solar. You could make a pretty solid argument that natural gas is less environmentally impactful than giant solar farms or wind turbines. So it's maybe that is them calling out the ESG for not being legitimate and trying to get back into oil when there's when people aren't paying attention. That could be very smart play of them. I agree.
And what do you think about the mortgage markets, the Ginnie Mae residential mortgage backed securities in particular? They're starting to trade at 70 to 80 cents on the dollar. And what happened was the convexity flipped from negative to positive because the prepayment options are basically out of the money or very deep out of the money. And you still have the real option to put the bonds back to the government in the event of a credit default.
Mhm.
So a credit default when they're trading at 70 to 80 cents on the dollar would actually increase the yield of a collateral pool filled with these bonds.
Mhm.
And so I wanted to get your thoughts on some of the distortions that we're seeing in the mortgage market. And when do you think some of the usual buyers like banks and insurance companies
Mhm.
are going to start buying in a big way back into these markets? There was a lot less of that in 2022. What do you see going forward?
So a lot of that specific stuff, I couldn't speak to every bit of it, but I can definitely tell you that there's a lot of things about our current housing market that make very little sense. And especially since people have now more embraced hybrid and remote work. There starts to be very little reason for somebody who could potentially work remote. Even my job, which is working at NASA as an EVA safety engineer, even my job I can do almost fully remote. you can even now support mission control fully remote, even including talking on a headset and everything. We have become so quick to be able to move to fully remote, and that has become such a viable option for so many people. It starts to make me, now it's starting to be a very big sell of, do I really want to live downtown near my office and have to pay 3 to 4 times as much for housing in a place with high crime that's crowded and loud? And it starts to not make much sense. It seems to not be a good option. And I think more and more people are going to realize, you know what, I don't need to do this for my job. Why don't I just go live out in the sticks? And I have an internet connection, so I can still work. And the sticks are very cheap to live in. And I think that is going to be a trend. And also what that'll also do is, and we also have a lot of problems with housing as well, of these regulations, and that's not really a problem in Texas, but things like certain regulations and zoning laws that make it impossible, make it an intentional artificial housing shortage, because there's so many people with a lot of stake in real estate that own the property. Well, they don't want their property value to go down when somebody tears down all these little old houses and makes bigger ones, or builds apartments or something where you can house more people. Well, that's going to lower the the value of your house, because now you don't have to pay 3 to 4 times what it's really worth just to live in that area. And this is obviously a big problem in a place like, California and the West Coast. I also think another thing to consider is inflation. A lot of these mortgages, if inflation is really bad, but you go and, if I agree with the bank, we're going to have I'm going to take a mortgage for $300,000 and we have a bunch of really crazy inflation. Well, the bank is losing out if the inflation rate is higher than my interest rate. Correct? I mean, because the amount we've already settled on an amount, you can't just hike that amount. And because of that, if that might be them trying to assume that might be them trying to make a prediction that inflation is kind of here to stay, and that we're going to have more inflation issues. That'd be the easiest answer to why they would do that. And I just do think that, and also I think overall, the other thing is less and less people that are younger can even get mortgages. So it's going to be something where it's becoming smaller and smaller market anyway, when the world moves more and more to a subscription system.
Okay, but just for the counter argument's sake, in 2022, Citadel became the most successful hedge fund ever in terms of the dollar amount of returns, US dollar based returns that they've made for their limited partners, passing Bridgewater Associates. The founder, Ken Griffin, made about $4 billion for himself, according to Bloomberg's calculations. And he attributes a lot of their success to the fact that 98% plus of his workforce is in the office. What do you say to some of the skeptics out there who say we've got to be in the office? Is there some validity to that, or do you think
there is? Yeah. Well, there is. I mean, obviously, there is a lot of purpose. There's a lot of reasons to be in the office. I actually think that more people should be in the office. However, it's definitely a fact that workers tend to like the hybrid to online type. It's easier to go and balance your life a little bit. It's kind of nice to work in your pajamas. Can't argue with that. There is a lot of convenience, and even if I actually agree that from a business perspective, I would not really want people at home all the time. It probably would affect productivity, especially if you're a very high intensity, high pace, a very kind of high speed type of industry. Or, I'm sorry, you can't be at work from home as an airline pilot. You can't work from home as a ship captain. There's just some jobs you can't do that from. You work at from home cop is not happening. It's just, so there's some things like this that you can't do it anyway. But also, so there's always going to be those people that need to work in person, but there's some jobs where it's definitely easier. Like software engineering is something very easy to do remote. If you're if you're, but I would definitely imagine, especially hedge funds, I don't think that's a good thing to do remote. Especially with hedge funds, there's a lot of proprietary information. There's a lot of sort of secrecy and security around the strategies, the tactics, the sort of what the investments are. And obviously, the more stuff that's done remote is also a higher chance of security breaches, because it's more data that's transferred across the internet instead of me talking to somebody in person in the office. Way easier to keep things kind of on the down low there, but way less likely to have leaks of any sort like this, because you don't want somebody to know your strategy before you use it and then do something like a short squeeze if they're your competitor. Like the GameStop thing happening over and over again would not be fun for most of these hedge funds, because there's plenty of people that want to do that sort of thing to them. So yeah, I mean, I definitely think that there's definitely validity. I'm not actually on the side of people necessarily working from home. I just say that enough industries have found out that it's possible, and that it will definitely drastically affect the real estate market, because a lot of people will not put up with the downsides of living in a city, because there's a lot of them. It costs more, there's higher rates of crime, it's not, the schools aren't as good if you have a family, now you have to pay for private school or whatever. There's a lot of costs associated with living in urban areas that are financial, but also kind of like lifestyle compromises. And if we're comparing, and that will make that, in my opinion, will make a lot of these overinflated housing prices fall. I also think a lot of them are going to fall in general, just because when people aren't going to be able to afford them, I mean, eventually, I don't really know how they're going to even stay full. And I think a lot of them will get torn down for apartments over time, because there's still going to be more people, and less people that can afford to live in the houses, especially from our generation, because of the house pricing have outpaced the generic inflation by a substantial margin.
Yeah, and I wanted to ask you also about something that happened on Monday. On Monday, we saw the Merrill Option Volatility Estimate, which is basically an implied volatility index for bonds, spike by almost 24% in a single trading day, according to Yahoo Finance. Do you think this was driven solely by the situation with Silicon Valley Bank, or is this a more system-wide incident? Because what's interesting about it is global bond markets also rallied that same trading day by more than 100 basis points this past Monday. And so just wanted to get your thoughts on what's going on from a 100,000-foot view in global fixed income markets, particularly on the volatility side.
And we're talking about like bonds and corporations too, not just bonds and the government.
Yeah, the Merrill Option Volatility Estimate looks at Treasury interest rate volatility, but it's used as a proxy for volatility for pretty much all bond markets worldwide. Okay. So the corporate market, yeah. Mortgage market, etc.
Okay, cool. Because with the Treasury, there could be the problem of the runaway, the debt spiral problem that could be coming up. That is obviously going to make that, in my opinion, should make people question their trust in the U.S. financial system. As soon as we get to the point where we're in a debt spiral, where the interest rate on the debt is higher than the taxable revenue, you're in trouble. I mean, now you can't pay it back unless you do something drastic, like cut all huge amounts of government spending and raise tax revenue a huge amount. And if you just keep printing it, well, it doesn't really make the problem go away. It makes the problem worse. So that's where there's going to be a lot of issues, in my opinion, because it will, that could be one thing affecting the bond market, is sort of instability of the U.S. system, just in general. That's getting worse and worse. And also, I mean, with corporations, I think that along with that instability, also is instability within the general economy. When you, because the government, especially with how big it is quite a large force on our economy. And if something is wrong with that, it's going to affect everything downstream. And I think that's probably where there's a lot of volatility, especially compared to globally, because a lot of these problems that we're having in America, specifically with our system, and our economy and just our social climate even, don't affect other countries as much. I mean, there's still a lot of them are still dependent on the dollar, but they don't have a lot of the same debt problems. Some countries do, like Japan, but they don't have the same debt issues. And a lot of them, especially some of the countries that I have a lot of experience with, obviously, don't have economies that are this complicated. Where my wife is from, Belize, even during the entire Great Depression, the only thing that her grandmother noticed when the Great Depression was happening was that you couldn't import soap. Other than that, their life was completely normal. And that should be really telling about these sort of agrarian economies that are more these sort of third world economies. They are, especially if their government is not very, very corrupt, and they don't have a lot of strange money printing, inflation type of issues like you see sometimes in Africa with places like Zimbabwe. They actually tend to be really economically stable. Now they might not grow as much, but instead of having this sort of up and down a lot, they kind of just go flat up. They're very stable. They're not very unpredictable. And that would still be the case in Belize right now. If America just collapsed tomorrow, the only thing all they would have a hard time getting is things like tech products and cars. They could still get food, they could still build houses, everything. They just wouldn't be able to easily get big trucks, although they would probably just get them from China or from Japan. And they wouldn't be able to get things like certain cell phones and maybe some like fancy clothes, and that's really, so in a lot of those countries like that, and even countries like Europe and a lot of these other countries that have more stable economies that don't have these debt problems, maybe there's this idea that maybe the euro is a little better than the dollar or whatever's going on. But I think a lot of other countries are looking on the up and up economically a lot more than we are, unfortunately. Yeah, if you go into the sound settings, I'm